Imagine investing just $100 every month, not $1,000, not $10,000, just $100. Now imagine doing that consistently for 20 years. Depending on how you invest, that small monthly habit could grow into $36,000, $58,000, even close to $100,000. And the crazy part? You only invested $24,000 total. In today's video, I'll show you 5 beginner portfolio strategies from very safe to very aggressive, and exactly what they could look like after 20 years of investing $100 per month. By the end, you'll know which strategy is best for beginners and which one many long-term investors secretly use. Let's start with the safest option. This portfolio focuses on stability and low volatility. It's designed for people who hate seeing their portfolio drop during market crashes. A typical allocation might look like this: 30% global stock market, 60% bonds, 10% cash or money market. Many investors use funds like the Vanguard Total World Stock ETF and the Vanguard Total Bond Market ETF. Bonds don't grow as fast as stocks, but they help reduce risk and smooth out market swings. Historically, this kind of portfolio averages about 4% per year. So what happens if you invest $100 per month for 20 years? You invest $24,000 total, and your portfolio could grow to about $36,700. Not explosive growth, but very stable. This strategy is best for people who are close to retirement or extremely risk-averse. But if you're younger, you might want more growth. The next strategy is the classic 60-40 portfolio. This one has been used by professional investors for decades. The allocation is simple: 60% stocks, 40% bonds. This mix balances growth and stability. Stocks provide long-term growth, while bonds reduce the damage during market crashes. For example, investors might combine a broad stock ETF like Vanguard, total stock market ETF, and a bond ETF like Vanguard, total bond market ETF. Historically, this type of portfolio returns about 6% per year. If you invest $100 per month for 20 years, here's the result. You invest $24,000. Your portfolio could grow to around $46,000, almost double your money. This is one of the most common portfolios used by beginner investors and retirement funds. But we can still push growth further. Now we move into growth investing. This strategy focuses mainly on stocks, which historically outperform most other assets over long periods. The portfolio might look like AS to 100% global index funds. Many investors simply buy one ETF tracking the S&P 500 or the total world market. Examples include Vanguard S&P 500 ETF, Vanguard Total World Stock ETF. These funds hold hundreds or even thousands of companies. Companies like Apple, Microsoft, Amazon, and thousands more across the global economy. Historically, broad stock markets average about 8% per year. With the same $100 per month investment, here's the result after 20 years. You still invest $24,000, but your portfolio could grow to about $58,900. That's more than double your contributions. For most young investors, this simple index fund strategy is considered one of the best long-term approaches. But some investors want even faster growth. Now we enter aggressive investing. This strategy tilts toward high-growth sectors, especially technology. A typical allocation might be 70% broad stock market, 20% tech-focused ETF, 10% emerging markets. A popular tech ETF is the Invesco QQQ Trust, which tracks many of the largest tech companies. Technology has historically grown faster than many other sectors, but it also experiences larger crashes. So, volatility increases. If this portfolio averages about 10% per year, here's the outcome. Investing $100 per month for 20 years. Your total contribution is still $24,000. But the portfolio could grow to about $75,900. That's more than triple what you invested. However, this strategy comes with bigger ups and downs, especially during market corrections. And then there's the most aggressive option. The final strategy adds a small allocation to cryptocurrency. This is a high-risk, high-reward approach. The portfolio might look like 75% global stocks, 15% growth or tech ETFs, 10% cryptocurrency. Many investors choose large crypto assets like Bitcoin and Ethereum. Cryptocurrency is extremely volatile. Prices can swing dramatically within months. But if the portfolio averages around 12% annual growth, the results can be powerful. Again, investing $100 per month for 20 years. Total invested, $24,000. Potential portfolio value, about $98,900. Almost $100,000 from a small monthly habit. Of course, this strategy also carries the highest uncertainty. Here's the most important takeaway. Your success doesn't depend on picking perfect stocks. It depends on 3 things. 1. Consistency. 2. Time in the market. 3. Low fees. Even the safest strategy still grows your money over time. And the difference between strategies mostly comes down to risk tolerance. Many experienced investors actually keep things simple with just 1 or 2 index funds. Because over long periods, the global stock market tends to grow as the economy grows. Just imagine this. If you increase your investment from $100 to $300 per month and keep doing it for 30 years, the numbers start reaching hundreds of thousands of dollars. That's the power of compound interest. The earlier you start, the more time your money has to grow. So whether you choose a conservative portfolio or an aggressive one, the most important step is simple. Start investing. Even if it's just $100 a month. If you found this helpful, please hit the like and subscribe button for more videos about investing. Thanks for watching. I'll see you again in the next video.